Right now, as we look at the market on this Thursday, December 4, 2025, Supermicro Computer Inc., ticker symbol SMCI, is trading at exactly 33.64 USD. We are seeing a very minor intraday movement, down just 0.037 points, or roughly 0.11% for the day so far. It is a quiet morning on the charts, but do not let that stillness fool you. Beneath this flatline price action lies one of the most volatile, debated, and potentially explosive narratives in the entire hardware sector. Most investors looking at this chart see a stock that has gone nowhere for the better part of a year, a company seemingly stuck in the mud after the dramatic fall from grace we witnessed back in late 2024. The general expectation, the street consensus if you will, is that Supermicro is currently in the penalty box. The narrative is that after the accounting delays, the auditor resignation drama of last year, and the massive trust deficit that was created, this stock is simply dead money until proven otherwise. They expect it to drift, maybe bleed out slowly as competitors like Dell and HPE eat their lunch in the AI server space. But here is the reality that contradicts that sleepy expectation. Supermicro Computer is quietly positioning itself for a revenue breakout that the market is not currently pricing in. While the stock price has been dormant, hovering in this low 30s range, the company has been aggressively actively restructuring its internal controls and, more importantly, pushing forward with a fiscal 2026 revenue target of nearly $36 billion. If you run the math on $36 billion in revenue against a market cap that has been beaten down to these levels, you're looking at a valuation disconnect that is rarely seen in the technology sector. We are not talking about a dying business. We are talking about a hyper-growth engine that got a flat tire, fixed it, and is now revving the engine while the crowd is still looking at the old damage. The disconnect between the broken stock narrative and the growing business reality is where the opportunity and the danger lives. To understand why this price point of 33.64 USD is so critical, we have to look at the psychological battle being fought right now. We are seeing a distinct consolidation phase. For months, the stock has struggled to break significantly above the $35 mark, which has acted as a ceiling of resistance. Every time it gets close, selling pressure kicks in, likely from bag holders who bought in much higher during the mania of early 2024 and are just looking to get out at break-even or minimize losses. On the flip side, there is a very hard floor around $30. Every time it dips near there, value buyers step in. This compression, this tightening of the trading range, usually precedes a massive move. It's like a coiled spring. The market is waiting for a catalyst, and that catalyst is likely going to be the confirmation that their profit margins are stabilizing. Let's talk about the elephant in the room that is still haunting this chart, the trust discount. When you are looking at NVIDIA stock, you are looking at a company that is priced for perfection because the market trusts its execution implicitly. When you look at Apple stock, you see a premium valuation because of the safety of its ecosystem. Supermicro does not have that luxury right now. The scar tissue from the Ernst & Young resignation in October 2024 is still fresh in many institutional memories. When a Big Four auditor walks away, it leaves a stain that takes quarters, sometimes years, to scrub clean. This is why, despite the booming demand for AI infrastructure, SMCI is trading at a fraction of the multiples you see elsewhere in the semiconductor and hardware supply chain. Investors are essentially saying, "We do not believe your numbers yet." This skepticism is what keeps the price suppressed at $33.64, but it is also what creates the asymmetric upside. If the new auditor signs off cleanly on the next few quarters, and if that trust discount evaporates, the repricing could be violent and rapid. However, we cannot ignore the competitive landscape, which has shifted aggressively while Supermicro was busy fighting for its NASDAQ compliance life. During the months that SMCI was dealing with its internal turmoil, companies like Dell Technologies and Hewlett-Packard Enterprise did not sit still. They aggressively courted Supermicro's biggest customers. We saw reports of orders from major AI players, including parts of the Tesla stock ecosystem and CoreWeave, shifting towards Dell. This is the bear case that keeps a lid on the price. The fear is that Supermicro has lost its first-mover advantage. In the past, they were always the first to market with the newest NVIDIA chips. They could build a server rack faster than anyone else. But if enterprise customers are now prioritizing supply chain stability and corporate governance over pure speed, SMCI loses its edge. This is the tension you need to watch. Can Supermicro prove that its building block architecture is still superior enough to outweigh the governance risks? Speaking of that architecture, let's pause and analyze exactly what this company does for those who might just be tuning into the story. Supermicro Computer is not just a generic box mover. Their entire business model is predicated on modularity. Think of it like Lego blocks for data centers. Instead of designing a completely new server every time a new chip comes out, they have a library of subsystems, power supplies, cooling units, motherboards, chassis that they can mix and match to create a custom solution in weeks, whereas competitors might take months. This building block solutions approach is their secret sauce. It allows them to offer thousands of different configurations, catering to everything from massive hyperscale cloud providers to smaller research institutes. This flexibility is key, especially in the era of AI where power and cooling requirements are changing almost monthly. And that brings us to the most critical technological moat they have: liquid cooling. As we move deeper into the era of massive large language model training clusters, traditional air cooling just doesn't cut it. When you're packing thousands of GPUs into a data center, the heat generation is immense. Supermicro has been betting on direct liquid cooling technology for years, long before it was the industry standard. They can deploy liquid-cooled racks at scale, which reduces electricity costs for the data center operator and allows the chips to run faster without throttling. This is where the investment thesis gets interesting. If energy efficiency becomes the #1 bottleneck for AI scaling, and many experts believe it already is, then Supermicro's lead in liquid cooling could be the factor that brings those lost customers back. It's a tangible, engineering-based advantage that's hard to replicate overnight. Now, I want you to take a second and engage with this idea. We are talking about a company that is essentially the plumbing for the AI revolution. Comment below how many shares of Supermicro Computer you currently hold, or if you were staying on the sidelines until the audit situation is 100% clarified. Are you in the value trap camp or the undervalued gem camp? I want to see where the sentiment is among you guys. Let's get back to the financial mechanics. We mentioned the $36 billion revenue target for fiscal 2026. This is aggressive. To hit this, they need to not only retain their current customers, but expand significantly into the sovereign AI market, nations building their own data centers, and the enterprise market. This is where the Schwab Intelligent Portfolios or Fidelity crowd often gets confused. They see a hardware company and think low-margin commodity, and historically, they're right. Server hardware is a brutal business with razor-thin margins. You are often fighting for pennies on the dollar. This is why SMCI's gross margins have been a point of contention, often hovering in the mid to high 16s or even lower during aggressive expansion phases. The concern right now is that to win back business from Dell, Supermicro might be slashing prices, further compressing those margins. If they hit $36 billion in revenue, but do it at 10% gross margin, the bottom line earnings growth won't look nearly as impressive. This is the profitless prosperity risk that you need to be aware of. However, there is a macro wind blowing in their favor. We are seeing a broadening of the AI trade. It is no longer just about the Mag 7 buying chips. We are seeing Tier 2 cloud providers, sovereign wealth funds, and large enterprises entering the fray. These buyers often don't have the massive engineering teams that a Google or a Meta has. They need a partner who can deliver a turnkey solution, a full rack, plugged in, liquid-cooled, and ready to go. This is Supermicro's sweet spot. They offer rack-scale, plug-and-play solutions. If you were a mid-sized investment firm or a healthcare company wanting to train your own models, you don't want to assemble servers yourself. You want to buy a finished supercomputer. SMCI sells that. This shift from selling components to selling full solutions should, in theory, help support margins over time, even if the hardware itself becomes commoditized. We also need to discuss the ownership structure and the founder mode aspect. Charles Liang, the founder, is still very much at the helm. On one hand, this is great. He's a visionary engineer